Black Swan.
Hello traders, FX here from Black Swan, and welcome to our mini series on advanced market structure. This series is going to be a three-part series, and we're going to be covering some of the essential aspects of what we feel is really important to know for market structure if you're trading supply and demand. And this series is mainly going to be focusing on the 4H and 15M timeframes. And within this series, what you can expect to learn is structure types, structural liquidity, weak and strong structure points, the development of a leg of price, what will happen, why structure is fractal, multi-time frame analysis, how to interpret order flow correctly, and forming a directional bias by doing top-down analysis. So this first video is just to serve as an introduction, where we're going to cover a leg of price and what you can expect to see within a leg of price. Okay, so as supply and demand smart money traders at Black Swan, we believe in every single market there is an entity what controls price, okay, and we can call them the composite operator, and it's their job to manipulate price and move price to predetermined pricing levels, what is in line with their broader economic objectives. And the problem is for them is that they have so much capital to inject into the market, they simply can't just buy and sell with one trade, because there's not enough liquidity on the other end of their trade to pick up their orders. So what they will do is they will create legs of price, and within that leg of price we will get several different types of structure what is engineered to build liquidity, to collect enough orders, then to give us our liquidity fuel, so to say, for the next structural move. So it's really important to think about structure. It is the most important aspect of developing a trade idea, okay? Structure takes priority over supply and demand, over change of character if you use that to trade, or a supply and demand flip, because structure gives us our direction, okay? Our highs and low in the market are engineered with trillions of dollars of capital, okay? They're simply not just going to shift, especially the higher time frame swing points in a market. They simply are not just going to shift, okay? So it's very important when you start to look at structure that you prioritize structure over everything else, okay? If structure is not aligned with your trade idea, then you need to reevaluate your trade idea, okay? So what we have here is a 4-hour bullish market, and what I've drawn in for you is what you can expect to see on a 15-minute complex pullback, what goes through a 15-minute bearish cycle, okay? So I'll just delete this. What do we have here? Well, we have our swing structure points, okay? And what is a swing point in the market? Well, a swing point is our controlling low and our controlling high. So it will either be our higher low and higher high, or lower low and lower high. In this example here, we've got higher highs and higher lows because we're bullish. And we've just created a new high here, yeah? So the last low we can call a strong low. And it's a strong low because it took out a high, yeah? So our directional bias can be based on the fact this high is weak. So what is the job of a strong low or strong high? Well, these strong lows and strong highs are protected by the composite operator. They're putting these structural points into the market and they're protecting it with billions and trillions of dollars, yeah? These are points in the market what are not gonna be broken. And it's important when I say this, we use the higher time frames to get these really, really key structural levels, okay? Because 5S, 1M is a little bit different in terms of what's gonna hold, yeah? Our 4H structural points, you know, these are solid points what are gonna give us a good directional bias in the market, yeah? So we've got a strong low here, and it's characterized by the fact it's taken out a high, giving us a bullish bias for this market, right? And as supply and demand traders, we know we're not looking for trades until we trade back into our demand level. Now, we're going to cover supply and demand in a future mini-series, so I'm not going to talk too much about it, but if you have any questions about supply and demand, please just ask one of us in the Telegram and we'll be happy to help you. Okay, so we've got these strong and weak structural points. Our bias is obviously based on biscuit and run, and obviously I've already drawn out what happened so we can see it gets run. But what plays out on the 15M and what's the purpose of its structural movements? So we see we come in and we create a low. Now, as supply and demand traders, to us it's not hit anything relevant, okay? There's not a demand level there. But to your average retail trader, and there's absolutely millions of them, they think this is going to be the low, what takes the high and creates a new high. So you've got millions upon millions of trades coming in, right? You've got all this liquidity pouring in because you've got all this FOMO, because everybody has the same directional bias. We all think it's bullish because we're taking out swing points, we're having breaks of structure. But what happens? Well, we know the composite operator, this is not enough for them to fuel the next structural leg in price. They're going to need to build orders over a period of time, right? So yeah, it runs, but then the structural point gets broken. So what's that doing? That is releasing all the stop orders below that low and injecting liquidity into the market, giving the composite operator the orders at this pricing level they want, yeah? Because they're going to continue to stack orders until they satisfied their requirement, their order requirement, right? So what do we get here? So now we know we're in a 4-hour pullback to our demand level. So we're having a 15-minute bearish cycle, right? And as supply and demand traders, we know that we now have a strong internal high within this internal range of price, what we can look to trade on, okay? So if we come in, we get the right confirmations, and the confirmations play out, we can then assess that this low, because this low still not hit our demand level, and we can use this as a liquidity target to get in on counter trend trades, which is fantastic. But at the same time, we're not the only people selling these highs, right? Because now everybody who's been taken out of the buy side is starting to think this market is going to turn around and it's going to reverse, and we're gonna go bearish, right? So we're seeing lower highs, and then all your FOMO retail traders, what we're looking to buy this market, they're now all selling. And this is what the composite operator would do to engineer liquidity into the market for the next structural leg. Because when the composite operator is ready to take price, past this swing structural point, it's going to collect all these orders because they're going to inject so much demand into the market, it outstrips all the available supply. So price becomes more expensive. More demand, more expensive price is, right? That is basic supply and demand principles. So, when is right for us to get involved? So, we're taking our counter trend trades, which is great, but, we want to get involved in the real move. Price comes and hits our demand level. Many things can happen here. A, we could be wrong, and actually the market does reverse and goes bearish. So we need to sort of wait for the right confirmations. So what does that look like? Well, price comes into demand. We can see it respects our demand level, pushes out, creates equal highs. So equal highs or equal lows is a really, really strong confluence that the composite operator is getting ready to expand price, because above every equal high and below every equal low, we have resting liquidity. And then when we get this, more times than it doesn't, it will look to get run. So what you have to do though is make sure you're basing your liquidity idea within your structural play, okay? So we know we've got potentially a bullish market because we've got cause to go higher because we've already taken out a high, yeah? And we've respected our demand level. So if we get our equal high, we can look to stack buys here, or we can wait for further confirmations. Then we wait for minor structure to start failing, because at this stage of the cycle within the leg of price here, the substructural points have been exhausted. The amount of orders the composite operator needs to accumulate has been satisfied. So now they need to move price aggressively. So what they're going to do, they're going to diminish supply. So how do you diminish supply? Well, you've collected all your orders, so it's time to inject demand into the market that outstrips supply. And then this is where you get your price expansion. So the first signs of this within a leg of price is when we get our minor structural break, okay? So this would be visible on the 15M within a 4-hour structural move. And using supply and demand again, we can identify key levels to look to get involved to then get the big move to take out the structural highs. So it's all good, me giving you this diagram, but let's see a live market example. So just below here, what do we see? We're in a 4-hour market cycle, bullish market cycle, sorry. We're trending upwards, and here we have our 15M bearish pullback. Okay, so this is when 15M swing structure goes bearish. We start to pull back, and what do? Well, we're creating equal lows, which is giving us our resting liquidity. We get to run, we're making substructural points, and at the same time, everybody's selling, right? Everybody's selling, giving us our available liquidity for the move. So price comes down, hits some sort of demand level here, I don't have it marked out, sorry, gives us the equal highs, and now this is where we can get the confluence to get involved. And this is obviously a really good example of where it plays out really, really well. But if you back test this yourself, look back at data, you can see this same thing happens again and again and again and again. But yeah, that's it for this video, guys. Just like I said, just an introduction, and we're going to get a bit more in depth for the second and third part of the series. Thanks for watching.